Picture this, a beloved, absolutely bedrock financial titan. We're talking about an institution that survived the horrific panic of 1893, weathered the devastating years-long storm of the Great Depression, and stood tall through 2 entire world wars. For over a century, it was literally the picture of conservative, boring, unbreakable financial stability. But then, in the span of just 9 days, it completely vaporized. A towering empire holding hundreds of billions of dollars in assets, completely erased. And I want to be clear, this wasn't just a bad quarter on the stock market. This was a spectacular, fatal collapse driven by a billion-dollar dark secret, massive corporate hubris, and a fundamental betrayal of the very principles that built it in the first place. In this explainer, we are going to break down the anatomy of the absolute largest bank failure in the United States history. But before we reveal the name of this fallen giant and the sheer terrifying scale of its collapse, we really have to look back. To understand how perfectly this institution hid its fatal flaw from regulators, from Wall Street, and even from its own customers, we have to look at its incredibly wholesome origins. Because, as you'll see, the way it started is the exact opposite of how it ended.
All right, part 1, the innocent innovator.
Our story begins not in a shiny skyscraper on Wall Street, but in the smoldering aftermath of a devastating city fire in 1889. The local community was in absolute ruins, and people desperately needed capital to literally rebuild their lives from the ashes. Out of this crisis, a really modest 2-person operation was born. Working from a single shared desk in a tiny second-floor office, they founded a conservative building and loan association. Their goal wasn't to generate massive wealth for elite shareholders. No, they were strictly focused on the working class, helping their neighbors finance homes and rebuild their city, brick by brick. Now, this brings up an absolutely crucial difference. What exactly is a mutual bank? Well, unlike a regular commercial bank that's driven by outside shareholders constantly demanding high quarterly profits, a mutual bank is an entirely different beast. It's actually owned and operated by its own depositors. The people putting their savings into the vault are the literal owners. This structural difference meant that their entire corporate DNA prioritized absolute ironclad security over the chance of a big, risky profit.
And for decades, it worked. They earned immense trust through wholesome community innovations. I mean, they actually created a penny deposit program in local schools just to teach kids the value of thrift and saving. As they grew, they even pioneered early cash machines and telephone banking. Because of their hyper-conservative lending, they survived 2 terrifying bank runs during the Great Depression without even breaking a sweat. In fact, for a century, they proudly advertised a motto that was mathematically true: no depositor has ever lost a dime.
Moving into the 1990s, we hit part 2, the Walmart ambition. The financial landscape of America was changing fast, and the appointment of a highly ambitious new CEO fundamentally altered the DNA of this quiet institution. He looked at the massive profits being generated by aggressive national banks and decided that slow and steady was no longer going to cut it. In a revealing 2003 interview, the CEO, Kerry Killinger, explicitly stated his master plan: "We hope to do to this industry what Walmart did to theirs." He wanted to transform the company into the undisputed Walmart of banking. The strategy? Aggressively target the lower and middle class customers that elite banks ignored, and scale up at a breakneck, unprecedented pace. But behind the scenes of this massive expansion, there was absolute operational chaos. To become a national powerhouse overnight, they couldn't just open branches organically. So they went on a wild shopping spree. They rapidly acquired companies like the credit card issuer Providian and the specialty mortgage finance company Long Beach Mortgage. From a business and risk perspective, though, this was a ticking time bomb. They never properly integrated the IT systems or the risk controls of these acquired companies. You had independent loan origination platforms operating in total silos, with executives literally manually typing numbers into spreadsheets just to figure out their overall risk exposure. It was a complete mess. To try and unify this sprawling, chaotic empire, they rolled out a dangerous new corporate motto and marketing campaign called the Power of Yes. They wanted customers to feel like they would literally never be turned down for a loan. Armed with this aggressive new identity, the institution leaped headfirst into the booming, high-risk housing market, completely abandoning the conservative mutual banking roots that had kept them safe for over a century.
Which brings us to part 3, the subprime temptation.
To fuel this massive Walmart-style growth, standard mortgages just weren't enough anymore. The margins were way too thin. So they began aggressively marketing subprime loans to people with bad credit. At the heart of this machine was a financial product they heavily promoted called the option arm, or adjustable rate mortgage. They sold this to the public as all the loan you'll ever need. Imagine taking out a massive loan where your minimum payment doesn't even cover the interest and the rest is just secretly added back to your total debt. It's a complete financial illusion. When the deferment period inevitably ended, borrowers were hit with massive, devastating payment shocks that they had absolutely zero ability to pay.
The internal culture became an absolute wild west of shoddy underwriting. Loan officers were financially rewarded purely for the sheer volume of loans they pumped out, not the quality. Top producers who originated the most risky loans were rewarded with luxury trips to Hawaii. They even aggressively pushed safe, fixed-rate customers into these risky option arms just to boost their own margins. In one famously absurd instance uncovered by investigators, they actually approved a six-figure home loan for a borrower claiming to be a high-income mariachi singer. The only proof of income they required? A literal photograph of the man standing in his mariachi costume. You really can't make this stuff up.
Now you might be asking yourself, where were the adults in the room? Well, the truth is, internal risk managers were sounding the alarm. They desperately warned top management about the reckless danger of these Option A arms and subprime loans. But those warnings were fatal to the power of yes. Risk managers were routinely ignored, intentionally excluded from meetings, pressured to sweep their adverse findings under the rug, and in some cases, outright fired for speaking up against the profit machine. But the music had to stop eventually. The tension finally boiled over when the housing bubble violently burst in mid-2007. The whole conveyor belt halted. The bank was suddenly choking on its own toxic assets, suffering a $1 billion loss in the fourth quarter of 2007 and then another $1 billion loss in the first quarter of 2008. In a desperate bid for survival, they managed to secure a massive $7 billion private equity lifeline from TPG Capital. They finally discontinued the option arms, but the toxic rot was already deep inside the foundation. So now we reach part 4, the 9-day death spiral. We are in September 2008.
The consequences of their power of yes strategy are about to violently collide with a global financial panic. On September 15, 2008, the Wall Street giant Lehman Brothers declared bankruptcy. The global financial system essentially froze overnight. Terrified depositors, reading the headlines and watching the stock prices plummet, immediately lost whatever remaining faith they had in our heavily exposed, struggling institution.
What followed was a devastating modern bank run. But there were no screaming crowds in the lobby like you'd see in the 1930s. This was silent, methodical, and entirely digital. Over the course of just 9 days, nervous depositors, corporations, and wealthy clients quietly drained an incredible $16.7 billion in cash straight out of the bank's accounts. The institution was entirely bled dry of its operating liquidity. Completely out of cash and unable to borrow a single cent from a terrified market, the endgame arrived. Fearing that a public, messy collapse would drain the entire FDIC insurance fund, the federal government stepped in. They held a secret emergency auction. And on Thursday night, September 25th, exactly 119 years after it was originally founded to help a burning city rebuild, regulators officially seized the bank. And the veil is finally lifted. The institution was Washington Mutual, affectionately known by millions simply as WaMu. With a staggering $307 billion in seized assets, Washington Mutual officially became, and still remains to this day, the absolute largest bank failure in United States history. But the story doesn't end there. Part 5, the unprecedented aftermath. You see, a $307 billion giant doesn't just disappear quietly into the night. The sudden execution of the nation's largest savings and loan association kicked off one of the most complex, chaotic, and vicious legal battles the corporate world has ever seen. That very same Thursday night, to protect depositors and prevent a wider panic, the FDIC immediately sold Washington Mutual's massive banking operations. They sold its 2,300 branches, its deposits, and its viable assets to JP Chase for the shockingly low, absolute bargain basement price of just $1.9 billion. JP Chase effectively acquired a massive national footprint for literally pennies on the dollar.
Here is where it gets incredibly messy. JP Morgan only bought the bank's subsidiary, not the parent holding company. This triggered a fierce, multi-year Chapter 11 bankruptcy tug-of-war. You had the Washington Mutual Holding Company fighting against JP Chase, and both of them were fighting against the FDIC. They were battling it out over billions of dollars in disputed trust securities, historic tax refunds, and stranded deposit accounts. It was an absolute legal quagmire.
It took over 3.5 years of intense, bitter legal warfare for a bankruptcy judge to finally approve a reorganization plan in March 2012. The global settlement distributed roughly $7 billion to various creditors. In a wild twist, several hedge funds even had to pay $75 million to settle claims that they were actually engaging in insider trading during the bankruptcy process. But what about the everyday shareholders? The regular folks who believed in the 119-year-old beloved brand? They were absolutely devastated, left holding equity in a tiny, obscure reinsurance shell company.
Washington Mutual survived the Panic of 1893. It survived the Great Depression. It survived 2 world wars. But ultimately, it was destroyed by its own hubris, its unchecked ambition, and its fatal addiction to toxic subprime mortgages. The $307 billion collapse of WaMu stands as a permanent monument to the dangers of sacrificing deeply held business principles for rapid, reckless growth. It really leaves us all to wonder, when the next huge market boom comes around, will the broader financial world actually remember the dark side of the power of yes? And more importantly, will you?